religious text. Usually it has to do with the relationship between yourself, your intellect, and your spirit within inside you. That divine intuition, that, I guess we call it, lack of a better term, the little tiny voice, right? You're always working those two from an esoteric standpoint. And in trading, it's the same thing. You're looking at the markets as a manipulated and rigged market. And that type of self-dialogue is different than the dialogue of just the mechanical outer stuff, all right? So we want to try to bring you guys through this progression of information. First, we'll start with last night's pre-market session. Last night, we had GU as AFP to the downside only. It was all red. We had the outside structure, of course, that was opposing. And this would have been the chart that we were looking at together. It's pretty obvious. We were in AFP short. That was the one and only direction. You can see here the type 1 London pattern with a very nice follow through. You've got to watch out when you're designing your stop loss to break even strategy on the 5-minute trades. They really do tend to whip back into the range. So a stop loss to break even strategy on a 5-minute type 1 London pattern can get a little tricky. And that's why data is power. Data being how many type 1 London patterns have you walked through to determine the distance at which you want to roll your stop loss to break even. Okay, so these are obviously deeper issues. That's not for the ones, that's for the 99s like Aaron. Right? Or 9999999. That is funny. That made my night, brother. All right, so beautiful type 1 London pattern away from pick formation, right? We had the outside structure that was anchoring this. So that was an interesting bounce. It was away from outside structure as well. If you're into the minutia here, I didn't mark it as a setup, but we could easily call this a type 4 London pattern that fired right in here, breaking the Asia range away from outside structure. Your stop loss will be 10 pips from the tip edge of that bottom stop hunt candle, right? Type 4 London patterns, we'll go through them again. I really want to basically go through all the pieces independently. Kind of, I guess, in Steve's mind, the way he did boot camp was to take all the separate pieces of the teaching and really flesh them out one at a time. So that's my goal for this new year. And we'll obviously be looking at the type 4 London pattern to get us a better vantage on that. I did go through it rather quickly when we did our studies of it. But anytime you see an outside structure, you're looking for the break of the Asia range. And then you're looking for price to collapse back into the Asia range. If you have a nameable pattern down here, then you take the trade. If you don't have a nameable pattern, you basically trade as it crosses back into the Asia range. But you have to make sure you have a 10 pip stop in the distance away from that stop hunt candle. Same thing on the top edge. Outside structure is your anchor point. You're trading away from that outside structure, collapse below the Asia range. That's your entry. 10 pips is above the top edge of the day. You've got to give some room in these type 4 London patterns because sometimes they come back and reinduce and pull it back down. So I'm going to leave this chart here handy as we roll forward. I think that will actually be helpful. And let's continue on, okay? So that was the long trade. So we did have a type 4 London pattern to the long side here, all right? And that worked out pretty well. So we'll talk about all the pieces of this puzzle one at a time here. So we're going to start tonight with the basics of the market maker cycle, or the H1 market maker cycle. It is this drawing. You need to commit this drawing to memory, and it needs to be so strong in your memory that you can see its variations in the real-time charts. And it is a visual thing. It's not a technical thing. That's why this drawing is so important. This drawing will show up on all the time frames from H1 and below. Sometimes it shows up on the higher time frames as well, but oftentimes it doesn't. Most of the time it's H1 and below. And let me ask, since we've got some 9s in this group here, why does Jim say that it has a tendency to show up H1 and below and not as much on the H4 and the daily? Why would I say that? What's the reasoning behind saying that? And that's a pop quiz for the 9s, not the 1s. Remember, brand new people, type 1 if you're here, and you got in a little late. If you've been around for a while, I guess do what Aaron did and type in several 9s, I think without a decimal point. But think about this question. Why am I asking this question? Because I want you to realize why it is you see this market maker cycle on H1 charts and below, and not so much up on the daily. You see it on the daily. It certainly happens once in a while, but it's not as regular. Why is it more regular on the lower time frames? Anybody want to take a stab at answering that? Why would you see this market maker cycle in H1 and below more than you'd see it on the daily? Because the higher time frames aren't that easy to manipulate. That is correct. My friend Reinhold from south of the border, give him a trophy here. Okay, that is the answer. All right, and I'm trying to grab a picture of it, but it's not working so well. Let me see here. Let me move some screens around. Bear with me. Yeah, that's absolutely the answer. And when you're looking at the market this way, and your dialogue is now shifting from an exoteric dialogue to an esoteric dialogue, right? You're looking at the essence of something. You're looking at the inside workings of something, not just the outer presentation of it. You're not looking at the surface. You're looking at what's underneath it. What's underneath it? It doesn't cost as much money for a market maker to move price, to manipulate the herd from the H1 and below. If you were to move a D1 chart, that has to be a lot of money to do that. And that's usually the hedging banks. Those would be the people that are also working with the market makers, but in a more detached manner. They're not in the day-to-day operations. Those are traders that put positions on for longer term runs and longer term movements. So it's really a question of the fact that the market is extremely manipulated from the H1 and below. It's not as manipulated above the H1. When you get to the H4, you get to the D1, then you have activities that revolve more around these high volume areas and hedging banks. And basically, nation states that trade their own currencies, right? We've got a lot of nations that have what are called sovereign funds, which is where the nation state basically has a bank with multiple currencies in it, and there are traders that are trying to draw a profit on that money that a nation state actually holds. It's basically a nation state savings account. It's called a sovereign fund. And those are operators in the Forex market, but they're most likely in that range of D1 charts in the higher time frame. So really it's a question of the manipulation being far easier to do on the lower time frames. Okay, some good additional answers here. Nice. Lower time frames aren't easily manipulatable. That's correct. Crowd psychology is fractal. It is. Crowd psychology is fractal, but if you don't have the money to push a D1 chart in 3 moves all the time and you're not in line with what the hedging banks are doing, it'd be very easy to not make as much money. Basically, the bottom line is this. The retail market loves the lower time frames. The banks, the hedge funds, the sovereign funds, those guys like the higher time frames. And guess who has more money? That's an obvious one. And guess who's more nubile at it? Guess who doesn't have as much experience? That would be the retail traders. They don't have the experience, and that's taken advantage of. So I'm glad you all saw that. This particular drawing is set up in a way that we see Monday, Tuesday, Wednesday, Thursday, Friday. It is a drawing of an H1 chart. And in this case, we have a market maker cycle with the peak low on Monday into level 1 by Wednesday, up into level 2 Thursday and Friday, and then back down into the range at the end of the day and Friday. And it's the same thing the other direction. Now, this is the ideal. This is what we would call the Mona Lisa. This is I guess we'd say the basic template, the benchmark that architects use is a term called the benchmark. These are the ideals, but we need to understand that this will shift around. You'll have occasions where sometimes the peak is in the middle of the week and the reversals right at the edge of Friday into Monday. It moves around a lot, but in terms of a starting place for us to wrap our brains around this particular algorithmic approach to trading, we need to see this from a Monday to Friday. And that's because a lot of times price doesn't really change at the beginning to the end of the week. You can see this drawing. It's very simple to perhaps pull this down a bit further and bring this one up a bit further, and it starts and ends in the same place during the week. This is a market maker cycle, and the reason this works as well has to do with all the trend strategies that are out there where people are lured into strong trends, and this is what cuts them to pieces. Okay, so if I were to find a photograph, for instance, of a poker dealer And I'd show you the esoteric view of him where he's standing behind the desk and their cards, and he's got a tuxedo on, and he's got maybe a top hat if it's a very fancy place. And he's dealing the cards. There's nothing to see there. But if you were to look from an esoteric standpoint behind him, right, you see cameras and mirrors. You might even see one of those little apparatuses that fits extra cards underneath his sleeve, right? The difference between magicians and market makers, there isn't much of a difference. It's really the same thing. You're trying to create an illusion. You're trying to create a perception that most people believe, and you're trying to give them a incentive to engage at that moment, and then you completely reverse it and go the other direction. That's essentially the mindset of this market maker cycle. That's why it's so devious, but at the same time, so effective. So I want you to commit to your mind what this thing looks like. And the reason that this rig works, the reason that this manipulation works, has to do with the imbalance of trade volume. Imbalance of trade volume, you will not see that taught anywhere. It doesn't exist. The reason that it doesn't exist is because this is such a lucrative business. Very few figure it out, and fewer still are taught by someone who had a part of it, which is why we're so blessed to have contact with Steve and Heidi, because Steve basically wouldn't have taught it if it weren't for Heidi. So I always give her props. He basically would not have been a teacher unless he taught her first. So it's extremely esoteric information. It's not going to be found anywhere. So don't think you could just Google this stuff up, and try to, if you're a new person, try to do your best to stay away from other trading information. It's a suggestion. Obviously, I'm not going to try to domineer you into such a standpoint, but I want to just let you know that so much of the trading education out there is purposely polluted with herd manipulation ideas. These ideas are not going to serve you. So, all right, just take a deep breath and let this really into your brain, because this is why we have these reversals at these areas. As the market is rising, we see an evenly balanced market of longs and shorts. Balance shifts a little bit as price begins to rise further. You have a bit more long than short volume in the market. And then you get these vector events, these extreme moves, very sharp, steady runs increasing as they move. That creates an overabundance of long traders and not that many short traders. That's the essence of this market maker cycle. This is the esoteric slide here. This is the exoteric. So this is the outer view of it, and then this is the inner view of it. And even if you've heard this information before, you can challenge yourself by asking the question during the next evening or day that you are live trading: how often is your self-dialogue dealing with the esoteric aspect of the market as compared to the exoteric? And can you merge the two? Can both of them operate at the same time? That is the ideal. That's what we want to get to, because we need external rules. We need exoteric rules. We need surface rules to formulate a win-loss ratio that's consistent over a period of time. But at the same time, we should know why events are happening. You should know what's happening on the esoteric level behind the market. When those two merge, you get that jump away from pessimism into optimism that's difficult to describe. And after this extended amount of long volume is in the market, then you get what's called the primary shift, which is the first bit of damage that the dealer does against his narrative of a continuation long bias. And we can run the thing to the downside. It's basically the same thing. As the market descends, the first move down, it's relatively balanced between longs and shorts, starts to increase. In terms of speed towards the downside, you begin to pick up more momentum shorts than longs. Then finally we have the vector, we have the extreme speed, that burst of price movement where everybody seems to want to get in short and not that many people want to reverse it. And this is really the main manipulation that is done. I want to, again, challenge you to keep this in mind when you're checking down an H1 chart. Are you looking at it from both an esoteric and an exoteric standpoint? That's what we want to see here. And eventually, after there is a sufficient amount of traders, overwhelmingly to the short side, the dealer will pull the market back into the range against those traders and stop out a portion of these short traders. Same thing above. Once the market is oversaturated on the top edge, they stop out a portion of those long traders. And it really doesn't matter what the big picture is. We can have an extreme move to the long side in a Forex pair, but in the middle of the week on Friday, they could still do this move, completely in contravention to the long trend that is possibly even a fundamental long trend where it really should just keep rising. But since the dealers own the H1 and below, they can play this game inside the week, even within a long trend. Same thing with the downside. They can play this game inside the week, even with a short trend. And it's extremely reliable on their end. And what happens when this initial amount of volume that got short, this momentum volume short, when it's stopped out, this is what happens to the amount of short orders that are still in the market. All right? All of a sudden, half of the short orders are gone because the dealers have stopped them out. Same thing on the top edge. As soon as we have a good amount of long orders in there and the dealer swipes away from those guys, it basically limits the amount of long orders that are currently in the market. All right, you can see there's still a remaining imbalance here. There's still more longs than shorts. On this side, there's still more shorts than longs. Now, I'll take a pause here because I'm trying to counsel the ones here, the people that are just joining us, to not get on the internet and try to find volume indicators or any type of volume stuff for the spot Forex market. We do teach volume-based trading here. Steve covers it quite a lot. I cover it a little as well. But that's a futures market, right? When we're talking about the spot Forex market, which is all the MT4 guys, and basically the normal FX brokers, you're dealing with the spot Forex market. It will never have accurate views of volume. So try not to find that fancy indicator that's going to somehow give you this. You will not find it. We try to use our multi-time frame RSI, which is TDI, to pick these bottom edges. We utilize as well a few rules that we'll talk about here in a second. But in terms of trying to get something that's going to give this to you, it doesn't exist. It just doesn't exist. In fact, if you study this to a great depth, you'll find there are a lot of trading systems that actually fire in this area the wrong direction. It's basically set up in such a way that your average retail trader comes in and buys a robot, buys an automatic trader, automatic advisor, whatever they call them these days. The name seems to change a lot. I think that's part of the rigging of it. Change the name, you change the game, no one catches on. It used to be called an expert advisor. Those things oftentimes are programmed with momentum moves that seem to love to enter on these vector moves down into level 3. I should know, I had one when I first started out and I watched how it traded. It was fantastic in trends, but as soon as one of these market maker cycles came along, it bit the dust very quickly. Okay, so try not to go outside of our group for this information. Try to rely on your own eyes on an H1 chart to see this type of behavior and then of course to see how price pulls back away from these primary shifts. That's essentially the starting point here. And Patricia sent me this pic over the holidays here, January 1st. We have been using a little bit of visuals to help steer you guys into the idea of the herd. And this was the YouTube that we have been using quite a lot last year. And interestingly, on her screen popped up this little friend. I thought it was quite interesting as well. She sent me the pic of one of her screens. She's got another screen on the right, but I thought that was great. But that's the idea. We're in a situation where the majority of traders see this trend continuing, and they're stuck in this mindset. They're stuck like a sheep being herded by the dogs to be stuck through that gate, so they all go through the gate. And this is the mindset of the market. This is the mind of the market right here. This is the reality of it. You've got reasons for them all piling in, but it's certainly not in their own brain as to why. They're just following the guy in front of them. And as a past instructor of mine used to say, they're just moving along like a cow, right? Moving along. And that's a huge part of what we talk about in terms of the esoteric part of the market. This is the esoteric. The charts and all the candles and the pretty colors is the exoteric. It's the outer view. So what we have is we have these strong trends that develop. We have traders that love to get in on these extremes. Then we have the market makers pulling back against them, but they don't pull back enough to violate the trend channel. Oftentimes there's still a channel at play where the dealer wants to exploit that one more time. He wants to get them one more time. And so here's an interesting tweet from yesterday. It says, "What even is real anymore?" I'm not sure if any of you saw the Seattle fireworks that weren't. Here's a person that's in a high rise. I'll blow this up a little bit. So the person says, what is even real anymore? And the one on top says, "First lie of 2021, we're off to a great start." But this is a great example of something being shown to you that a certain amount of the sheep, a certain amount of the herd is going to see as real. You're going to think, wow, they're doing these nice 3D holograms on the Space Needle. But look at this person lives in a high-rise apartment in Seattle. You can see the Space Needle here, nothing going on. But on the TV, there's all this showboating going on. So how many people see that as real is the question. This is the kind of stuff they did. It was very beautiful. If you saw what they did over New Year's in Seattle, they did fake fireworks. They did all this stuff. It looked like holograms. But the bottom line to this is some people will actually believe the illusion. Some people will see this as real. And it's the same with these trend channels, especially in the lower time frames on your H1 chart and below. They'll see these trend channels develop and they'll bite on them. And really it's a two-part situation that develops. And I want to make you aware of nice and slowly here. I want to make sure everybody's aware of this. But essentially, you have enough of the herd that will believe that these were real visual light events off the Space Needle and nothing's happening in real time. It's a video, actually. It's really hilarious. And again, it's part of what the controllers of our culture do is they present something with so much fantasy, with so many colors, and it's alluring and it just pulls you in. It's a form of fascination. And that gets you to then take the leap of reason where then you see something as what they're presenting to you as real when in the reality, there's nothing happening on the Space Needle. Nothing happening. So that perfectly illustrates this idea that a majority of the herd is going to see a continuation in both of these channels. And that's where the second move of the market maker cycle just beats the daylights out of them. So here we go. Going to Google the word trend trading strategy. You can see 84 million results. 84 million results. Imagine how many classes there are in there, how many PDFs, how many free classes are in there, paid classes, how many people trying to get you into a trend strategy. Well, let's become more specific with this. Interesting, it still shows an 8. We'll say Forex trend strategy. Pop that into Google, you will see 8,170,000 results. And if I could have gone one bit further and started putting in the time frames, 5-minute chart, 15-minute chart. If you're talking about a Forex trend trading strategy and it's from anywhere from the H1 and below, it's basically right here. It's a gigantic lie. Whoever's going to trade a trend strategy from the H1 and below is going to get absolutely creamed in the Forex market because of this market maker cycle and because of the variations that are thrown. Okay? So for you nines out there, for those that have been around for a while, think about when you're looking at AFPs and you're about to take an AFP, what does the herd see? And can you evaluate based on your knowledge of how many Forex trend trading strategies are out there? How many systems are firing when you're in this segment of the market after this first primary shift has happened against this illusionary trend channel? Ask yourself the question, try to get as clear as possible. I've even recommended to some people, not everybody, not all people function this way, but there are some people that can truly delve into the contrarian side and pull up 3, 4, 5 trading strategies literally taken off the internet that break when these market maker cycles produce. And it's not hard to do. It's not difficult to take someone else's strategy, pull up the WSM viewer, work your way on the H1 and M15, and see where that strategy would fire. And you'll actually see a lot of those strategies, especially the free ones, are basically getting into the market on this pullback, right? It's a channel break and a channel reversal. You'll see that quite often. So it depends on how deep you want to go. I don't think that's necessary. Most of us just want to make money and that's it. And I strongly suggest you try to stay focused and a very narrow view in that regard. You don't have to be a rocket scientist to flip the light switch on your wall, right? Yet you're not an electrician. You don't know how the wiring is functionally wrapping its way, shielded, I hope, through your walls into the power center. You don't need to know how a nuclear power plant works. You don't need to know these things to be able to throw a light switch. So again, it's a point of interest, I say, not as a point of departure for most people, right? Some people will get too wrapped up in that and they won't be productive. That's not what I want to suggest here for 2021. I want to try to get everyone as productive as possible. So this was initially going to be a 2-part. Now it's just a 1-part, but that's all right. We'll get to part number 2 next week, which is actually, we'll use the same quote we started with, because there's a mental thing that I wanted to talk about when it comes to basing your trading choices on the esoteric, not the exoteric only. It's both the exoteric and the esoteric together. Okay, so the simplified version of this manipulation that's done is that there's an inducement, there's a false momentum that's created. Then there's a trapping activity that's put into the price action, which is false breakouts, zone blocking, traps. Essentially, hopefully you know what a trap is. And then there's a shift, right? Then we have stop runs against trap traders. So in this instance, we can say this entire section is the inducement. This would be your trap, and then this would be your shift. So induced, trap, shift is how I want you to carve up this drawing of the market maker cycle. And when you get deeper into our material, you will see this on the M1 chart. You will see this on the M5 chart. You'll see it on the M15. You'll see it on the M30, although very few actually use the M30. You'll see it definitely on the H1 chart. Again, I wouldn't try to dig too deeply above the H4. H4 will have it from time to time. The D1 almost never. Okay, the D1 almost never. And you get above the D1 and it's even more almost never. When I say almost never, that means it sometimes happens, but it's not normal. Very normal, H1 and below. All right, we already talked about that. And then the second part of this is what they do to leverage off the emotional state of the average sheep that's in a trade in this trend trying to make it back after they get stopped out. Okay, so it's really what we're talking about in terms of this type of manipulation is the incredibly developed science of crowd control. It goes all the way back to ancient Rome, where they trained fleas to stay in jars, and crowd control worked its way all the way up through the Tavistock Institute and all those fun topics for you conspiratorial folks out there. And it wrapped its way right into MK Ultra, wrapped its way right through Scientology into the current time. We have incredible amounts of data of how the science of crowd control works, and it's all very easily translatable to the capital markets, to the leveraged financial markets. It's absolutely going on a constant basis. Just think about the mindset of the sheep and think about the mindset of the market maker that is working the sheep. And I guess we can zoom in and we can say it's this guy, because he's telling his dogs what to do. There's a dog up here shooing the sheep through the gate here. There's probably another dog over here, but he's directing the dogs what to do. So there is your market maker, and then here is the rest of the market, the herd. And a ton of them are using expert advisors. They're using automatic trading systems, a ton of them. Okay, so let's talk about this second component, which is where a lot of us are really digging in, and we have been for quite some time because it's still happening. Doesn't seem to be stopping at all. We had a bunch of them last night, in fact. We'll look at another example besides GU as we progress here. But what you have is you have a state where, again, the channels still exist. You have the primary shift, so we can say that anybody that was long this market, especially if they got in where everybody else got in, they took a loss. And ask yourself the question, when you took a loss as an early trader, what instrument did you go to in order to try to make back that loss? So let me be more specific. If you got stopped out of your robot on EU, what was the pair that most likely you'd go back to make it up? If you were to try to, before you had a knowledge of how to use risk, before you could understand leverage and understand how to use scaled risk above the waterline, things like that, you'd most likely go back to EU. You'd go back to the same pair that you got stopped out of. It's bizarre. It's the way our brains are wired. Again, we're animals primarily. And so next week we'll talk about the amygdala. We've got a lot, actually, interestingly enough, built this session constructing it on the amygdala and the concept of that part of the brain that always reverts back to these animal tendencies. And then woke up this morning and got the intense impression to go from absolute square one and work my way up. And I just decided to go with that, having full intent to go into the mind stuff. We'll do that next week. I'll go into that next week. But essentially, you do have a mind thing here where most people are going to go back to the scene of the crime to try to make it back. Right? That damn slot machine took my money. Well, you're not going to go to another slot machine. You're going to stick with that same slot machine because, hey, the more quarters go in that thing, the more the likelihood of a 777 to show up, right? It's everywhere. When you talk about, any type of speculation, you always seem to go back to that which took it from you. It's really weird. But that's what the market makers leverage. Okay, so again, we're going to talk about this AFP condition. It's a condition on the H1 chart. It doesn't determine the lower time frames at all. Those are basically separate players here. So if we're talking about the ideal trader uses both their left and their right hand to create their trades. In this case, the H1 market maker cycle is the left hand. We're not even dealing with the right hand, so we're not ever trading just off this information. This is just the left hand component. We mix it in with the right-hand component, which is the lower time frames. Those two together are what gives us a high probability trade. But what we're looking at here is what's called AFP condition, away from peak condition, otherwise known as level 1 condition. And the rules of this are very simple. Many days of rise or drop. You can see the days of rise here, days of drop here. And then we have our trap phase, right? We started with the induce. Now we have the trap phase. There are several types of traps that are well known. The first one, obviously, and you know what a trap, it's super clear to see what a trap is. A trap is where there's a lure set up so you touch it or grab it or take it, and right when you touch it, that thing goes whack and locks you in, and you can't get out of it unless you are at a loss. So in terms of trading, a trap is when you get in on a top edge move and the market pulls back away from you and you are down. You're negative position, negative float. So that means your brain's, that sends you right into the amygdala, that little part inside your brain we're going to talk about next week, those two little points in your brain. It's where all your emotional stuff started. It's where the heredity actually started to program you. When it comes to trading psychology, the place you need to go in terms of looking at your tendencies from childhood is actually on your mother's side. You need to look at your mother's state of mind around the time she was pregnant and just after you were born. Her ideas of money and finance and ideas of risk taking or not risk taking, risk aversion is the other side of risk taking, right? Those ideas of the availability of self perpetuating stuff. It would be like food. It would be anything that has to do with survival. So a self-preservation instinct was created in you basically the first 6 months of your life that is hardwired like an EEPROM chip programmed in your amygdala. So your tendencies that you developed in utero, right? Anybody with half of a brain understands that when a baby's kicking inside the womb, it's definitely alive. Your experiences in that womb, the amygdala was first forming, and it's taking the coding from the female and it's putting into that portion of your brain these hardwired animal instincts which have to do with raw survival. So again, the intention was to cover that tonight. We'll cover it next week. But just to get you going on that, because it makes sense with these traps. Because after you're trapped in something, your brain doesn't operate the same. It begins to operate more from an animal standpoint. We humorously call the chimp within, like the monkey within. We talk about that, where we have the monkey that's driving things instead of the person, right? We like to use visuals for that. That would be this guy right here, right? So that's someone that got trapped in a position who's holding the banana going, huh? What? So that's the state of mind that people are in when these AFPs fire. So we've got all the variations of traps here. We've got the M formation, the W formation. We have the head and shoulders formation. That's head and shoulders. So many days of rise into head and shoulders. Head and shoulders on both sides. It's a shoulder, head, shoulder. And we get into single spike peaks. Those do happen on occasion. We had a couple last night that did actually fail, that didn't work out so well. That would be USD CAD, right? And then we also have the U-shaped single spike, kind of a composite peak. It's usually a cord of wood up here where price just goes sideways and then it shifts. But as long as it has that 3 days of rise, 3 days of drop, and then this last rule in it, it's still an away from peak condition because a certain amount of traders are stopped out on these momentum moves that follow this sheep herding momentum. All right, then of course we're back to what we had here in the example, which is a three-legged M or a three-legged W. We do see a lot of peak formations that have multiple legs, and we see a lot of combinations of these. We see trap moves, but these trap moves are defined in order to have a clear trap. In order to be able to say that a trap has been put in, we need to have this decisive move away from the trap. We need to have a distance move of 50 pips or greater away from that area. Right? So this is what we call the primary shift. So we measure this distance from the topmost part of the peak down into the close of the day. So close of the day at extremes, at least 50 pips from peak to close. Okay, it wants to be at least 50. So in this case, greater than 50 pips, close of the day, puts us in what is called AFP condition. This is the one time in the market where I prefer to trade one direction. If we're in level 2, if we're in level 3, I have signature trades that can work out either direction based on what sets up. But none of the signature trades I take will I ever take back up into a peak formation when this set of events has occurred. This is the one time I'm looking at a one-way market. I'm not looking at a two-way market. Steve says, don't trade back into peak formation at level 1 consolidation. This is basically another way of saying the same thing. It's just the rules are stretched out. I dug in a little bit to what he said and tried to get a little more exoteric with it to give us some straight up rules. And you'll see me use these all the time in the pre-market session with no variations. I mean, it's pretty straight up. Okay, if a pair has, this is the one variation right here. We've seen this. We saw this last night in a couple pairs. But if a pair has an average daily range significantly below 100 pips a day, this number, this close of the day number, can be lower, such as 40 pips to close the day from peak extremes. Right? So in some cases, I think USD CHF last night, we had that as an away from peak condition because its average daily range was about 50 pips a day, not 100 pips a day. So this number does actually change a little bit if you're dealing with something that a pair that is not moving as big of a distance as the other pairs. So this is designed for pairs that have about an ADR of 100 pips. That's an average daily range of 100 pips. Okay, and the way you find close of the day, obviously on your terminal, there should be a vertical line. It's the beginning of the Asia box. Essentially, it's 5 p.m. Eastern Standard Time is the end of the day. So we saw here last night, we're sitting at January 5th currently. This was last night, January 4th. We saw the market makers, maybe the JV team, the junior market makers, are giving us exactly what we're talking about here. And I hope you can see it in the chart unaided without having to mark up this chart significantly. All right, so the days can be seen by the blue lines, right? You can see each one of these is a separate day. If I were to hit Control Y on my keyboard, it would draw a vertical line in here. I don't like the vertical lines. It just gets a little too messy. I can see the beginning of the day with the Asia box, right? This is the Asia box superimposed on an H1 chart, and I can see the beginning of the day when the blue tracer shifts. That's enough for me to see the end of the day. And you can see how the blue tracer shifted down here at the end of the day. So 5 p.m. Eastern Standard Time is where that day end is. And so we can actually walk through this chart. I can show you a single spike peak. You can see days of drop. In this case, it was 2.5 days of drop. The close of the day was way beyond 50 pips. You could see one kill shot here, and they did another kill shot at the end of the day. And ran it up. Okay, it was the very following day is the day that we're interested in. This is the same story. You can see days of rise. You can see this top edge created. More of a that would fall under. You can see the M there. You can see how it's an M. It could also be seen as a U shape, upside down U. But the close of the day was greater than 50 pips. Here was your away from peak condition. It fell away. Right. This was fewer than 3 days, but it's still a relevant example here. You had a 2-day drop. You can see 3 definite moves here to drop. That was your peak formation. Your shift was actually the next day. So the close of the day, AFP would have started right here, and that's where you got your straightaway. So even on this chart, and we can roll back into this guy here. You can see multiple days of rise. Close of the day, not quite 50 pips, but it rolled over away from that peak. So visually, you can see how consistent the AFP conditions are when they're meeting all of these criteria. Okay, so days of rise. Let's just look at this last one here as our example because it did happen last night. M-shaped trapping pattern. right? And this is the way I'm seeing the M. Okay, slanty M, kind of the second leg higher than the first, but it really showed itself on this shift phase, giving rise to, of course, the close of day at the extremes. You can see how it closed down here at the extreme. It didn't jump back into the middle of the range, which is not really an AFP. If this pulls back and closes the day back in the middle of the range, it's more of a level 3 condition. It's not an away from peak. We're looking for the one time where the H1 chart is telling us it's going in one direction, and the market makers have a consistent manipulation for this. It's most likely going to pay out. You're talking really strong probabilities of setups when you mix this left hand, the H1 chart, with a smaller time frame M5 chart, M1 chart, M15 chart. When those two come together, you have the higher probability move. So close of the day at the extremes, greater than 50 pips from peak highs. I can see that this is more than 50 pips. I hope you can see as well. For the newer folks, if you use these charts that I do post, and I've have all of my templates available for you. I post these after the pre-market sessions on Monday night and Tuesday night for you to use through the rest of the week with trap lines on them and all sorts of things on them. In terms of the indicators, one of the indicators I use is called an AFP price line grid, and it's literally drawing grid lines across the chart that are 00 suffixes. You move down, it's 25 pips down to the 75, another 25 pips to the 50, another 25 to the 25 area, and then down to the 00, and over it goes, with the exception of the quarter points, which are larger 2500 figures. Okay, so all you have to know is each one of these is 25 pips apart, and you can easily count from this top edge. You can count 25, 50, 75, 100, 125, add maybe 5 pips. We're looking at basically 130 in there. Okay, so this is a 25 pip distance. That's a 50 pip distance. If you have this indicator on your charts, okay, so I suggest to load up my templates as soon as possible and get this type of chart up on your screens so you can easily eyeball these distances. It helps at the end of the day. So we're looking at about 130 pips from the top edge to the bottom edge. AFP condition short, 100%. Now notice we also had the 1350 cross. This is where we get into more of Carr's focus. He likes the EMA focus a bit more, and he's an expert at the EMAs. I'm a little bit more into trap areas, high volume areas, and the market maker cycle. So we offset each other a little bit. In terms of peaks, the way that I draw a peak is I put a box around it, a white box. When Carr sees a peak, he doesn't draw the peak, he draws the levels with boxes. So you're going to see a slight difference between the way Carr checks down the market and how Jim checks down the market. They're two slightly different approaches, just so you're not thrown when you watch Carr's presentations and think that everything is just all over the place. It's really not. We each have our own discipline that has developed over the course of time. As we became profitable, Steve asked us to teach. And that's pretty much how it went. We're traders first, teachers second. That gets us off the hook for technical difficulties at some points, or at least it's a good excuse. All right, so after we have the primary shift, we're looking for a move towards the peak and then a shift back down. Now notice we have the outside structure in this case that limited the downside. We weren't looking for a move to take out that outside structure. I instructed you guys last night to take profit on this. You might actually have a trade head the other direction, which was our type 4 London pattern that actually did happen. All right, so we had trades both directions last night. Now we get to the US dollar. And of course, you can see the theme here. These are the hundreds of thousands of folks showing up in D.C. for the current election going on that's dragging out, a contested election, most definitely. The media won't tell you that, but in 75 million people's minds, they believe it's a contested election. All right, so that's why I put the people down here doing all their stuff. So that's going to create a downtrend in the U.S. dollar, right? And of course, we saw the COVID created a situation where I think 111,000 restaurants in the U.S. basically went completely broke, which is a big number because everybody was told to stay inside. And I'm not going to get off into the weeds on that topic, although I certainly can, especially since new numbers came out showing that there's not really a death difference between 2019 and 2020, but that's another topic we'll get into at a later date. Those numbers came out the last couple of weeks. It's pretty bizarre that there are fewer deaths actually attributed to what. Anyway, I'll get to that at some point. But in terms of trading, we see this perception that the U.S. can't get its act together. You guys did an election, and everybody's disagreeing on who the president is. What's going on? right? The media says one thing, the president and the 75, 80 million, maybe 120 million that actually voted for him say something else. That type of confusion will drop a currency, right? So this is what we had last night, was this red bar down. You can see the downtrend taking place in the US dollar. So I'll give you guys a pop quiz. When it comes to the prospect of holding a short in GU, this will factor in. With a strong downtrend in the US dollar, that will tend to push the GU which direction? Just want to make sure you're all still awake here. We're talking about that US dollar having a tendency to just roll over and roll over. I think it's lost almost 14, maybe 15% through the COVID and through this election debacle. Now, what does a trending dollar going down have a tendency to do to GU as a pair? Okay, and I'm liking what's coming through here. Just for the new folks, I just want to say, even though it seems complicated at first, a lot of people see it. Up, 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 up. That is the tendency. Now I say tendency because the GU is still, in much part, 50% is the actual pound. And the pound sometimes will run in line with the dollar. The pound will be strong, the dollar will be strong. And what does that do to the GU chart? It basically sends it sideways. Okay, so the main idea being, you might not have wanted to hold this short all that much further, certainly not beyond the outside structure, because over the course of, go back months, we've had a downtrend in the US dollar. So if you're short, that's a strong move in the US dollar. You want to make sure you cut that trade for the possible reversal to the long side. All right, so it's going to send the GU, it's going to tend to send it long. It's not universal. Again, I say there's sometimes the US dollar will move and the actual pound will move in the same direction. All right, so it does. There's a lot of independence when it comes to the London group over there. They really are an independent trading group, and they stick with their currency. Okay, we're very, very grateful for what they do, because it's my personal opinion that we are riding on their coattails. So God bless the motherland is all I can say. All right, so we have the move back into the peak. We have some trapping activity. We have the shift. That's our shift, the second shift that's happened away from peak. That was the point that we would have wanted to look at last night. A lot of our traders did get that. I think I saw 2 in the group that got that. And then, of course, we got this move away from the outside structure back long. All right, so we look at this chart from an exoteric standpoint. We see EMAs, we see a bounce off the blueberry, we see a bounce off the water, we see TDI, we see all that. And then you can look at it from the esoteric standpoint. You had a lot of volume that got stopped out on this move, and they re-engaged when this thing went up and the dealers stuck it to them. You had some volume actually short off this outside structure, that when price dropped, they went in line with that stop out that they sustained, and then price went away from them. So again, I want you to merge the exoteric and the esoteric to be a unified view. That is our 5-minute chart of this GU short, which was, I think, the ideal short. Basically an M off the Mayo, super clear move from last night, the 5th of January. Okay, so when it comes to the head and shoulders, I just want to show you how you draw that 50 pips close of the day. You would take the highest point of the peak. So we're using a head and shoulders as the example, but sometimes you have days of price action back and forth. You always take the most distant part of the peak and you measure that to the close of the day, not the most recent part. So if you have a slanted M, you take the highest point, and if you're on the bottom, you take the lowest point. That's the measure distance. That's the distance down to the close of the day to define AFP condition. Okay, so that's our first trap. That's trap number 1. So ladies and gentlemen, you've walked through the door to find trap number 1. Now we can talk about trap number 2 here. Christopher, I'll look for your messages. If you send them to me on Skype, I want to make sure everybody understands you must be relatively new. My email is something it's a seasonal thing. I think, what did Steve say? Jim hates email. I want to get you on Skype, Christopher. So please get me on Skype, friend me on Skype. I've typed in some posts into Cars. Actually, it's now called BTMM Chat. Go into BTMM Chat, grab my name, and friend me in Skype. That's how we're going to do business together. And the reason is because I have a running record of charts. Email is clunky. It's not easy for me to go back into previous emails and see what we talked about. In Skype, I can literally just scroll up and see all your charts. I can see what you've given me. I can see if you sent me homework. I can see if I've sent you materials. right? So that's what you want to do, Christopher. Okay, so I don't want to keep everybody here. How's everybody feeling right now? We're at the top of the hour. We've gone through the trap 1. Do we want to keep going? What do you guys say? What do you guys say? I'm going to leave it up to you. We do have the pre-market at 8:30 in 30 minutes. So it's really your call. Let me know if you want me to continue or if we want to put a bookmark here for next week. Okay, no one typing in. Continue, Jason says. Okay, I'll rely on the new guys. Let's keep going. It's 2021. Keep going. Okay. It's up to you, Aaron says. Yeah, that's true, but I just want to get your opinion on it. I tell you, every time I do these sessions, I try to make it fit 60, but something just, I'll eventually get it. But it's such a beautiful thing. I mean, I just don't know what to say. All right, let's go for a little while longer. I'll take you into the second section. So let's talk about the second trap. So we have the first trap, which is the primary trap, and then we have the second trap. It's called the kill shot. All right, now the kill shot is a completely separate thing, right? And it is the AFP section. It's where away from peak actually happens. Okay, so we have away from peak. All right, why does it work? Thurston the Great Magician does magic tricks. They all seem to fall to the tricks. Everybody falls to the tricks. Why is it? What makes this thing work? Why does it work? I've kind of already taught it to you. So even the brand new people, the ones, will still be able to somewhat answer this question. And the question is, how does the rig work? And why would we spend all this effort to try to figure out if a currency pair is in away from peak condition? And why would you do that? Well, it's because I want to trade that pair when it's in AFP condition, and there's a reason why it's really high probability, where it jumps off the chart, as it were. It jumps into another level of probabilities. And yes, I see one of you typing it in. You can continue. If I want to leave, I can basically come back and watch the recording and get the last 30 minutes on the recording. So if you guys are into the idea of a 1-hour session, by all means, cut out. I'm not going to be... I won't feel hurt in any sort of way. You could watch the recording. The recording is running right now. We're at 55 minutes and 57 seconds. And we will post this recording, so you can always take the first hour and then shove off and then watch the last 30 minutes if you so desire. Appreciate you typing that in. Okay, so why does it work? How does the rig work? What's going on? Somebody explain it to me. Tell me why this works. What's going on here? Try to encapsulate it. Make it like a sentence. Maybe a 2-sentence at the most. Are you going to work in the U.S. election tonight? I'm not going to have nothing to do with the election, Aaron. Am I going to work in it? Nope. I don't have anything to do with it. Happily so. So it's an interesting question. I mean, I love watching how the crowd is manipulated. I love seeing how things are rigged. And no, I'm not going to. In terms of talking about the election, no. All these charts are going to have to do with trading. Zero election on this one. We've covered that before. We've got enough there to hang your hat on. All right. Of course, I'm not taking a political stand with you guys. That's not my job. But I love watching rigs, and I love seeing how the crowd psychology works. Okay, so we definitely have a situation here where a lot of people will take away from peaks. They'll see that 5,200 cross, and they'll take the M off the Mayo, and everything's beautiful, and that's all you need to know. Some people don't need to know why a rig works. Like I said, the light switch on the wall is going to work regardless of your degree of electronics. Okay, so again, I'm going to put a bookmark here before I teach you how this works and why it works, and I want to take you back to the beginning of money. This is the oldest piece of paper money I could find. And it's nice that it's high resolution here. It's in French, of course, but it still illustrates a particular susceptibility of the human mind to tricks of finance. Various tricks of finance were started many, many moons ago, a long time ago. And in this case, this is what this is. So before we get to that, this is given to you if you bring gold to the banker. If you bring him some gold, you bring him some silver. All right? He gives you this receipt in return, and this is basically what it is. Your gold, and in order to get you to do that, to get you to bring the gold to him, they had to make you afraid, right? You had to be kind of afraid. Fear is one of the best inducements. It's an amazing thing. It actually works, and it has to do with this AFP condition, right? So your gold is not safe in your possession. Someone could steal it. Did you hear so-and-so had his gold stolen? Yeah, it's true. I mean, if you don't have a way to store and secure your gold, obviously if you have a lot of it, it could easily be stolen. So that's a risk. So they say, we will protect it. We will hold it for your protection and give you a piece of paper as a receipt of the value of that gold. You can redeem the gold anytime with a receipt, or you can trade the receipt for goods with other people. But we will loan out your gold without telling you so we can earn more. Right? So that's the catch. So they're holding your gold. They're giving you a piece of paper that you could trade with other people. But at the same time, they're going to take your gold and they're going to loan it out to other people. And you hope that that gold is still there. They say the gold is still there, but you don't really know if it's still there. Right? There are a lot of examples in history where that gold wasn't there. And all of a sudden, everybody came to redeem their gold. And the banker threw his hands up and he said, I don't have any more gold. What do you mean you don't have any more gold? I have all this paper that you had all your stuff on. Give me the gold back. That's the history of paper money. That's how it was born. So when you're looking at a $100 bill, when you're looking at a $20 bill, or you're looking at any of this stuff, right, understand that its inception was as a receipt. And they've been at this a very, very long time. And it's all connected. It's a 230-year plan you're looking at, taking 1790, subtracting from 2020, and we get 230. It actually should be 231 based on the fact we're at 2021 now. All right, but here you say it is a hypothecation and a reimbursement. That's what that is. I don't read French, but you can get enough out of it to say it's a hypothecation, which is where you give something that you now have a receipt for it, and then you have the reimbursement. So this is a representation of value where the value is no longer in your possession, but it's in the banker's possession. This is the beginning of paper money. And where's my other? I had another one here with a lady holding a 500 euro note. Let's see if I still have that up. Sometimes I save these pictures. Sometimes I say that'd be nice. Euro note. Yeah, there it is. So again, let me roll down. I thought it was perfect. She's got a nice smile on her face. There you go. So that's us currently today. It's money. I have value in my hands. Well, really, you have the perception of value in your hands. I wanted to pepper that in there because it just illustrates how far off of the reality of history most people are when it comes to currency itself. So now you're talking about learning to trade currency and you never had an idea of how the actual currency on paper started. It started as a receipt for value based on your fear of not being able to protect your possessions. Really is how it started. All right, so let's talk about this. So when it comes to how this AFP works and the reason that it works and the consistency of it, we saw it happen last night and there was no variation in terms of what happened. It was absolutely clear, is the fact that they're in the market at this point, even after your shifts have occurred away from peaks. When you have a shift away from a peak, 50 pips or greater, close of the day, there is still a larger amount of longs than shorts because there are still traders that got in lower down here. Their stops are most likely their stop loss to break even is somewhere below this area. So that still creates an imbalance in the market. More longs than shorts on the top side, more shorts than longs on the bottom side, even though a good portion of them got stopped out. I'll tell you what, the people that got stopped out on this move are the first ones that are going to get back in this thing based on their belief with the rest of the sheep that this trend is going to continue. And so they have a tendency to take another momentum entry as price is working back into this peak formation. And they're doing it from the standpoint of a revenge trade, where your trade is taken because you're pissed off that you got stopped out, not because of anything technical, not because of anything exoteric or esoteric, but simply because the amygdala inside your brain is programmed that when someone takes something from you, it's a time that you're in danger. You need to protect yourself. And based on your mother's experiences in utero, you in utero with your mother, and then the first formative years of your life, that amygdala is programmed in such a way that reflects her values and her risk aversion or desire to take risk. Right? It's hardwired in you. It's very, very cool when you get that part. All right. So as price again rises, in this case, we're looking at this area. As price rises, the herd still sees this long trend. And they again go long in order to make up for the loss they sustained on the primary shift. It's literally what it is. Literally what it is. And a automatic trading robot would absolutely be doing the same thing. If it sees a strong trend to the downside, part of its programming is getting short again on the pullback. All it has to do is confirm back down to the short side, and that automatic advisor will get right back in. So even if you're not physically trading, your robot will be trading this way. And if you're physically trading, the average person that gets stopped out on one of these moves, right? Say you went in short, you kept adding shorts here, and all of a sudden all of them went negative. You have no idea of a reasonable amount of risk to have on the table in any given trade, in any given day. Chances are a new person's down 10, 15%. You're so pissed off that you're probably going to risk more on this next trade than you are the initial trade that you got stopped out on. So that's why this is such a lucrative place in the market, because it's where revenge trading takes a hold. It's where that amygdala fires and people lose their ability to reason. And what happens when the traders get in to the long side on this move back up towards the peak? Again, the amount of volume long gets bigger. With all those momentum longs back in the market, how do the stops look? And this is the point that you need to become incredibly aware of, is where are the stops in the market? This is where an esoteric view that you take turns into where you place your take profit, because you're going to place your take profit where the obvious stops are, not beyond that area. Okay, so this is the subtlety. This is where the years and years of data builds up, where you can pick a take profit point with relative precision. And you can say to yourself, am I able to achieve a 2-to-1 reward risk ratio on this? I think I can. I could probably get 3-to-1 off of this. Okay, that's a good trade to take. And in another condition, you can say, can I get 2-to-1 on this? Well, maybe not. It looks like it might only go 1-to-1. Well, maybe I want to pass on that trade because I don't see the advantageous reward risk scenario presenting itself. So again, like Warren Buffett or any heavy-duty investor, they're sizing up companies based on risk. If I put in this amount of money, is it likely that I'm going to get more than I put in? And how long is that going to take? That equation gets crunched down into mere seconds when it comes to trading the Forex market and trading these high momentum markets, right? You don't have all the time in the world to prepare and ask those questions. You need to think basically on your toes, and most people don't. When their amygdala is ruling their choices, they just get in on the momentum as it rises. And my mistake when I first started trading AFP, knowing how consistent this was, I just started shorting as the thing rose. I was like, okay, if they're getting in long as this thing rises, I'm going to get short as it rises. Just no setup at all, no trap at all, just started getting. It worked for a period of time, and then it didn't work, right? So we want to have clear, decisive setups on the lower time frames to take advantage of this move. But it's the same thing going on. That is actually possibly doable with a grid trading strategy. If your stop loss is far enough outside of the range, you could grid trade away from peak conditions, but that's a whole other topic. I don't want to dig into that. But in terms of where these stops are, I want you to look at this and be able to, from where all the momentum has been created in this particular drawing, where are the stops for the shorts? Can you place them on the chart? Can you place the stops of anybody who's short this market right at this point? Where are the stops? And we could say, for instance, anybody who is short on these areas, where do they put their stops? And how many stops are there? How many people actually do this type of reversal? And you find it's actually not that many. So your stops on the short positions are above. There are very few of them. Now, where are the stops for the long position? And that's going to be interesting, because what that does is it helps you determine where your take profit's going to be. And you can get very precise with this if you wrap in 0-0 figures, mid figures, 50s, high volume areas, zone flips, EMAs, strong EMAs, right? All those can factor in along with this idea of where the stops are. So think about where the stops are on the long traders. Okay, think about it. They're all going to be down here. Okay, they're going to be probably a few up in here too, but most people will put their stops on the other side of the current trap edge. This is where the bulk of them will be. Most of the stops will be right down in here, and then they'll trickle down further, right? As various longs got in the market, you could say some of these are stop loss to break evens as well. And if someone were to take this series of moves at the bottom edge and they rode this thing up, their stop loss to break even would be in this area. So a stop loss to break even is actually also available cash to the dealer, although it's neutral cash. If they move the market enough, it actually becomes positive. But this is the picture. There are far more stops of the long traders than there are stops of the short traders in the market. Now, ask yourself this question. If you were a shark, which would you be interested in? This big group of stops on the bottom or the little tiny bit of stops on top? And my next question for you is, when you're looking at an AFP condition that's playing out, does this dialogue actually happen in your brain? Do you look at the market to do your check down with this esoteric idea, behind the screen idea? What's happening? How is it being rigged? What is the herd doing? How many sheep are stuck the wrong direction? Or do you just execute based on the exoteric, the surface material? All right, you can be successful doing just the exoteric. I understand that, but you get that extra leg of optimism and follow through due to the optimism by having the esoteric storyline as a part of your inner dialogue that you're using to make decisions, right? You hear the voice in your head, oh, you should get in, you should get out, you should trade this, you shouldn't trade this. Everybody has a certain amount of dialogue in their head. You can't tell me you don't. The question is, how much of your dialogue is reflecting this reality? And how much of it is just the exoteric reality, the surface? Are you on the surface or are you underneath the surface? Now, we can safely say that there is a way to go too far with this esoteric part. You want to have a nice balance with both of them. And it's interesting, if you read the words of Jesus, he taught both the esoteric and the exoteric. It's pretty amazing when you wrap your head around that. You see that he definitely was teaching, in part, the Bhagavad Gita, and at the same time, teaching at that point the traditional Judeo-Christian material, but he had this other thing wrapped in it, and there were two levels to what he taught. And it's basically the same thing when you're looking at charts. There should be an exoteric, there should be an esoteric. Both of them should be operative. You don't want to be too much into this, because then you'll lose sight of certain significant rules and principles that you need to keep yourself in a nice consistency, a data-based world. But at the same time, you need to know the why this stuff, why is it happening, and what are the expectations, and if you can hold that esoteric view in your mind and you see market behavior, you see things like them stretching this out to the right and not shifting as being the market makers accumulating more long orders. They want to get more revenge traders in before they rip it lower. And you have the patience to endure that wider trap here at the AFP condition, right? You can hold that position without being freaked out, because you understand, boy, there must be a lot of stops building up down below, because I see this channel's holding and the dealers are showing long. They keep showing long. You get into the minutia where the M1 chart has bursts long, where it looks like just all at once, it just screams long and then stops. Those are the types of things that, if you have this esoteric template in your mind well planted, you have this combination dialogue going on, and you have a lot better staying power for the inevitable kill shot. And look what it does. It takes out all those stops. So that's what's happening, physically happening in the market. The dealers, I don't want to go up there. There's only a couple stops up there. What, do I want to make all these people rich? No, I want to take their money. So I'm going to come rock their positions, because they're trading some trend trading strategy, and I'm running the M1 to the H1 chart. That's my world as a shark. I own those time frames. I can push the market any way I want. Even if it's supposed to go one direction or the other, I communicate with my hedging desk. I get my directions on how far I can push the market. I've got my limits of capital. I know what my limitations are. As long as I'm in those limitations, I'll stick them right away. I'll absolutely stuff these guys. And that's the way it works. It's a relentless money grab, and all it is basically a shark taking a bite out of the market. That's what it is. And can you ride with the shark? That's the question. And it looks like Matt's is riding the shark with a nice rip the other day. I think he's doing really well. Nice to see him posting that information. So big percentage numbers being knocked down by guys that are hitting this thing. And that's how it works. All of a sudden, stops are gone. Those stops are gone. What does it do to the actual size of liquidity? All of a sudden, there aren't that many longs left. And when you have one of these large momentum moves to the downside, what does that do? It builds up the shorts to the downside. And then you have a situation where the market makers induced an imbalance. They created the imbalance artificially. The herd bit on it. They took one bite out of them. They let them show a second move, and then they took the big bite out of them, where a lot of times the dealers will run the margin on people's accounts, because people get so afraid of losing that they over leverage to try to make it back. So the market makers induced an imbalance in the short and long positions, only to then simply move price into the larger group of reinduced stops to bring the market orders back into balance. An equal number of longs and shorts. Bring it back into balance. So when you can look at a chart based on price action, maybe the TDI, I like the TDI for the H1 chart. I love it for the H1 chart. When you can look at a few things and immediately determine that they're equal longs and shorts on both sides of the market, and therefore you say, I want to be very careful about taking a trade either direction, because I understand the dealer can run this thing either way. that's a gigantic filter you've just incorporated into your trading. And all of a sudden, your win rate goes from 76, 75 or so, and it jumps into the 80s. Right? You get into the 80% wins by thinking about this type of thing, and you're not getting goosed into something. Another one that would come from that would be if you did get let's say a London pattern formed here on level 2, and it's going to the short side, and you're in the thing. You're not at that point at the conviction that it's going to run a million pips. You take an opportunity trade. You take a 2-to-1. You take a 1.5-to-1. You take a 3-to-1. In some cases, you take a 1-to-1. Knowing that you're in a balanced market where the dealer they don't have the imbalance. The dealer hasn't created that imbalance of the herd and the sheepdog that's basically herding them, right? Or in the case, I guess it would be the hunter, right? So there is a balance. There's not an imbalance. So we want to seek where that imbalance is, and it's super simple. The rules are honestly incredibly simple. Many days of rise or drop. Single spike, M, W, head and shoulders, or U-shaped peak. Close the day at the extremes, greater than 50 pips. The exception is a pair that's under 100 pips ADR. You can sometimes accept 40 pips at the close of the day. All right, that's not something that's super complicated, but so few people will actually dial that in to a repeating self-narrative to actually use it when they're in the thick of things. Our brain tends to want to overcomplicate something if it's dangerous. If it's dangerous, we need all the information we possibly can get. We're going to sit ourselves down and do homework for 12 years and then eventually turn a profit. That's the tendency that unfortunately does happen when people begin their journey in Forex, is they get way too analytical. Where the person that just took this idea and says, you know what, I'm going to take London patterns and AR50s and AR safeties and such. I'm going to take those only away from peak. I'm going to have to watch 4 or 5 pairs maybe to be able to have that amount of inventory, because it's a single pair isn't going to put in an away from peak condition every day. It's going to maybe put 2 a week if you're lucky. Most of the time they do about 1 a week. We'll see. GU might put in another AFP this week, but it's already put in 1. I don't hold out for it putting in another 2 or 3. So I might need a few more pairs. In that case, all I'm doing is trading away from peak. All I'm doing is trading when this setup happens on the H1 chart in line with this. Your hit rate is going to rise by doing that. Yet you'll need more patience. Okay, so that's the essence of the rig. That's how it's done. It's based on the psychology of people losing and making decisions that are not reasonable and using way too much risk on that revenge trade to try to make it all back after they get stopped out. And the dealers will show them momentum in line with their mythical trend, and then they'll stop it right back against them on a regular basis. The news media loves to help with this part. This is as close as I'm getting to the election, Aaron. The news media loves this part, right, where it's going straight up. News media will come in and say something that's positive, this currency, right? Same thing on the reinducement after the peak has been put in. The news media will get in there and scream at the top of their lungs, oh my God, it's going up, it's going to the moon. We had a great example in Bitcoin where back when Bitcoin first started to fall off of its first peak, Goldman Sachs came out and said this thing's going to 20K. They were right. It was just 20K 6 years later or 4 years later, whatever, 3 years, who knows, whatever the time frame was, right? Definitely years later. It wasn't right away. So these guys love to get involved on these last moves. That's sometimes you can see this vector move, this third move, because there's some type of news media getting in there trying to do their job. So they're intimately tied with the trading desks. It's amazing, actually, to watch it. But it's all falls under crowd management. Crowd management, it's probably the biggest business on our planet right now. All the businesses revolve around crowd management. It's absolutely true. And the H150 setup happens here, by the way. So what we've done is we've stripped out the guts and the esoteric side of why the H150 bounce works. Carr focuses on that trade a lot. It's why it works. So we've basically just thrown it all in there. So if you want a super easy ride to any one of these trades, you can simply look at your H150 bounce type chart here. You can see we actually had one. There was your arrow fire, 5200 cross. Let's see if we got back. We barely touched to our extreme here. So this was actually a trade. You take that pullback and then you get it to the bottom. I'd be very wary to go past the Mayo. I think Carr usually will not take this trade when it's in between the Mayo and the water like this. But if you were able to get in on this pullback, at least you got some, right? But that is an H150 bounce. So basically, one curve, if you're here to quickly make money and you have a lot of time where you can sit in front of the screen and you don't mind watching a lot of pairs and you're able to focus, an H150 bounce is a good setup for you because it becomes an external version of everything we talked about from the esoteric side, right? From the inside, from the guts, from how the manipulation is done, how the herd is pulled into it, how they get into a revenge trade mindset. This is exactly what that is. It's an H150 bounce that's fired at the exact same point. So keep that in mind, depending on what your needs are. Everybody's different, right? Some people do have the secondary income at the time where trading doesn't need to pay a lot at this moment, where they can dig in and get into some of the deeper material to get the higher reward risk ratio sets. I think the H150 bounce is a 1-to-1 typically, a little more than 1-to-1 reward risk ratio, something like that. I think the guys are doing. But check with Carr for that trade. That's his focus is that type of trading, the bounce setups. All right, so last night, here's a variation for you. This was the EA. And the EA last night had AFPs both directions. Notice on my daily trade organizer, I've got level 1 AFP, level 1 AFP. So we had a bunch of shorts. We had some longs. The greens are long. The red is short, obviously. And this EA had both directions. So sometimes we do have away from peaks both directions. Okay, so there you go. So I've managed to put all the AFP stuff in one session. It's amazing, actually. I'm kind of glad I did this because I can point people to this session for all this reference. Because sometimes you'll have a very clear peak formation on the bottom. Hopefully you can see the way that W is. We had multiple days of drop. There's your W. This is how I see it, right? So look at it that way. There's your W, all right? And on the way up, interestingly enough, you had a 1, 2, and a vector into 3. So you had a mini cycle in here. It was a smaller cycle. Notice our D1 has been dropping. If I go back on that sheet, you'll see one of the other parameters that I had here on EA was a D1 downtrend. See how that D1 downtrend is? We'll cover that in another session, of course. But our D1 downtrend is illustrated by this blueberry, which on most of your charts is a Mayo. On mine, I make it match my M15 chart. But that gives us a downtrend with this stubby little 1, 2, 3 back. And boy, I've talked about this forever. We have that pullback into the blueberry, and then you measure from the bottom of the trap up, you've got 50 pips or greater. This is greater, obviously, you can see that. And you had greater than 50 pips down. It was just a little above 50, right? But you can still see it. These are 25 pips apart, right? So you can see that you had 50 pips close of the day on a single spike peak. In this case, you had 50 pips close of the day after days of drop and a W formation, right? So AFP both directions is what you got. AFP long, AFP short. How do you trade it? How do you trade it? Well, the question is, and this is where your computer in your brain has to take over, because hopefully you're going to be smarter than your intellect as you wind on down the road with your shadow not taller than your soul. You will eventually program that internal computer to be just as smart as what this guy is using, right? Meaning he's not alone. When I ask the question, is the market maker smart enough to run the same rig both directions? Well, it sure helps that he's not alone in doing that. He's enlisting the algorithm to do that. My own personal opinion, after passing through this information for several years now, is that it's far more driven by computers than it is humans doing all this kind of stuff, because a human isn't going to be able to tabulate 3,000 brokers across the planet very quickly. A computer can learn that stuff right away. A computer knows right away if there's an imbalance of volume. And I also suggest that this volume imbalance that we're talking about is not super drastic. I'm drawing it out to hype it up for you, to give it an exaggerated perception so you can take it and understand that it's probably a lot less of a differential, but it's a differential nonetheless. And it ends up building up the dealer's book in a big way. So in this case, he has volume trapped on both sides. And let's see how that played out. So we're dropping away from this peak, dropping away. Notice we trapped through our previous high volume area to the left, and we made a move higher. There must be a setup in there. And notice where it's coming to also. It's coming to the Asia midline. And then it drops away. And of course, our D1 downtrend is the prevailing direction. So we had the D1 basically give rise to a larger move to the downside, but we did have a reversal long here. And what you ended up happening, interestingly enough, is you had a kill shot long and you had a kill shot short. And if you can see it this way, as as the charts are playing out and you have that dialogue that's seeing the esoteric and the exoteric, tell you what, you have confidence that's insane. And you have that ability to not waste a bunch of mental energy on questioning things and all that, and you're engaged. And at the end of the year, you have a nice ROI. Okay, so long kill shot, short kill shot. We know what this one is. You all should know what trade setup that is. AR safety. Carr teaches that setup. It's an absolute beauty. Look at the close below the catch-up. Close below all the EMAs, right? All the EMAs that collapse down. Here's your first leg, back to the Asia midline. AR safety, meaning you pass through the Asia range. I'll let him teach that one to you. But that was there to the short side in line with our bigger peak, right? Our single spike peak that might turn into a reset, right? And then also we had this kill shot here. Now, if we zoom in on this, if we take a close look on this one, like a sniper rifle, we'll find that there's an M1W in there. Isn't that pretty? First leg, second leg. This is last night, guys. I'm telling you not to trade, or I'm counseling you to, I counseled everybody to trade the GU and maybe the GJ last night, but focus on the GU for this week since we have lower liquidity levels. But at the same time, this did set up last night in EA with the M1 microcycle. It did happen in our Frankfurt gap box. All right, so let's track that thing through, see what kind of results we had. So an entry anywhere above that EMA, you can see how it closed below, close above, close below, close above. Anywhere up there is your entry. Stop loss is below. Remember, your stop loss goes in first. Then you isolate your entry. You get your lot size. And we've got a 1-to-1, 2-to-1, almost a 3-to-1. We're looking at about a 2.9-to-1. And this thing was over in like 30 minutes. 30 minutes. You had that extra confidence from the higher time frame to give you the confidence to take this on the lower time frame. Yes, that's one of our setups. If you would have endured this nasty pullback, which might have stopped you at a break even, depending on where your break even strategy is, it's a big deal in terms of your data. You need to know where your break even strategy is, and you need to go back and look at hundreds of iterations of a given trade setup to get a reasonable idea of where a break even is going to be placed. And it's going to vary per pair. Every pair is slightly different where you put your break even based on the same strategy. Now, what's nice is that some setups don't vary. I know Carr uses a fixed type of break even strategy, but the more I look at these M1 cycles, I have a slightly different break even strategy depending on the pair. And it becomes obvious once you've looked back far enough. So there's a 4-to-1 if you waited for the pullback. That was a nice move back into the 618. Look how it anchored at that 618 right there. Let's see if I have this set up. Let's see if we can draw that. I'd like to be able to draw that here. Where's my EA? Let's just flip over to the EA. I do want to draw a fib there. My eyeball tells me that's absolutely a 618 pullback, where it pulled back to the 618 and pinned through it a little bit, but then rotated back up and kept going. So if part of your strategy was to hold through the pullback and allow it to breathe at the 618, you were able to capture a 4-to-1 on this one. And even further, you could have got a 6-to-1 if you allowed it to pull back to the 618 one more time and then up to the 6-to-1 reward risk ratio. Let's go have a look. See here. Let's use the M1 on this case. All right, so this is the most recent move. That's the down move. This is the long move. Just out of the eyeball, the corner of my eye, you can see there it is. Okay, so we'll move that in there. So it was a 618, but it breathed through it. See what I said? Now that's just proof to you. You saw it right here with, no fancy tricks. I've trained myself to see fibs without needing the fib indicator. This was what I saw in my brain, pretty much clearly. I knew it came back to the 618 and then pinned its way beneath it, but it really held at the 618 and ran up. I noticed this other one here, similar story. Okay, this one came down, bounced off the 618, went down even further, played with it a little further, cleared out a lot of people before it worked its way up. But this is the game that they do. They try to shake people out that got the move right. Personally, for me, I'd most likely be out either here or here. I wouldn't wait for the larger move, but the larger move played out quite brilliantly with a 618. I'm going so fast with lingo that you don't know. Well, Jeffrey, welcome to the party, my friend. This is why we have, at this point, hundreds of hours of recording. I've attempted through this session tonight to try to get you as much the basic idea of the H1 level conditions as possible. I added this other bit of information for the folks that have been around for a while. All right, so that was kind of a journey from the shallow end of the pool, doing a little, toe dipping, immediately scuba diving the 12-foot deep end of the pool there. So I don't expect you to understand all that lingo at the outset. What we'll do is we'll try to unwrap this thing nice and slowly through the year to try to get that lingo better situated in your mind. All right, so I do apologize for that. And in terms of your question, what setup is this? It's the M1 microcycle setup. All right, Jeffrey, do I have your? Hit me on Skype. I'll send you recordings. What a very effective way forward for students is to ask me questions in Skype. I'm interested in this, and this, and this. Do you have any videos on this topic? I can send you into the video archive of material that I've covered to recover this type of setup. But I do have, at this point, 10 1.5-hour sessions on this setup alone, which that's a lot of hours. That's almost 15 hours, maybe probably more, knowing me. 15 hours of information just on this setup. So hit me on Skype. All right, SC Lee, I appreciate that. That's my friend in Singapore, I believe. Thank you for that. Yeah, wanted to do just to start the year, right? And all we did here tonight, I put in this other stuff just to, I always like when a person, I ask, type in a 1 if you're brand new and someone types in 9999999. I want to make sure I cover them as well. So I try to get all people covered here. But all we did tonight was we covered just this peak H1 part. We didn't really get into the D1, the D1 trends, the outside structure. We didn't get into the London patterns at all, except right here at the end, we did the M1 London pattern at the very end. But we're going to get through each one of these as we go. We're going to take it slow. We're going to try to cover the basics, and I'll pop in as much information as I can to keep the advanced people interested. All right, so we're no weekend study module map this week. We're still in a low liquidity holiday week, so don't expect the WSM map. I've rearranged the full screen M1 optional charts. I've split the files out. So this is what will be posted on Friday. Anybody that uses the M1 full screen chart files for the WSM viewer, go ahead and load them up and see how that works. Tante, I believe you're still here. Let me know if this works for you. If this is out of the range, I'll have to split up GU on its own. I know you're in Nigeria, and I know that internet is in the dark ages there. So let me know how this 6-pack gets to you, right? 6 pairs. Actually, it's 6 pairs, set A, and then set B. I need you guys to feed back to me on this at the end of the week, or actually end of the weekend. I'm trying to make it easier for you guys to load the M1 full screens. Try to get it on there. So, all right, so another one of my brothers from Africa who's up in the middle of the night. God bless you. I feel honored with your presence. I guess I've just said it. I'll split out GU, and that'll allow me actually to taper down this group as well. So I'll do GU, and then I'll do a group of, what do we got? If we take GU out of the equation, it's 1, 2, 3, 4, 5, 6, 1, 2, 3, 4, 5. So it'll be a group of 5, a group of 6, and a group of 1. All right. So again, those that are in Africa or in other nations, you're going to have packet issues coming across. So these big downloads will take a long time coming through, especially if your government likes to. I know we had a trader in Saudi Arabia. We probably still do. He's probably watching the recording. But they're notorious at stepping on the internet. So you don't have the bandwidth coming in internationally. So that'll mess you up. So yeah, we'll split GU out for 2021. Just lay that out. GU will be on its own. And then all the rest of the pairs will be in these groups of 6 and 6, I think. 6 and 5, rather. It'll be 6 and 5. So GU, and then this group, and then this group. Let me know how that works out. All right? We'll leave you where we started. Pessimism leads to weakness. Optimism leads to power. And we're talking the leveraged capital markets. The very first lesson that I want you to understand is how to use risk. And so instead of rebuilding the thing next week, I'll point you into some sessions that I've done that should build that idea for you, so you're never in a pessimistic standpoint, even when you lose. And that'll be what we talk about next week in terms of the amygdala, the way your brain is hardwired to really screw things up when it takes a stop loss. I mean, it's really everything, and especially if your mom had any sort of money worries, if your maternal mother had money worries, coded into the amygdala in your brain is going to be this stuff. So that's where we'll pick it up next week. We'll do a psychological pointed session next week, and we'll recover some of the risk material, and we'll look at what happened, obviously, in terms of the trades that set up. So I think we covered it all tonight, guys. Remember, right? Think this over. Data is power, and that is in relation to the win-loss break-even. You want to compile for yourself a win-loss break-even with years of data. That is where you need to spend your extra time. All right, so new people, it's a bit of a journey to get to where I'm talking about here, but this is where all the algos are. This is where all the big banks are. This is where all the larger traders go. is into an algo perception where it's a win-loss ratio. I know I win this amount, and I know I lose this amount, so when I lose, it's not going to really get me down. But you have this crazy monkey inside your head, and he's going to throw a hissy fit. You'll need to manage that. So next week, that's where we'll go. Until then, there's a screensaver for you if you're so interested. We'll go ahead and post this recording for everybody if you missed it or want to review it. We'll post this in the forum, and I will shift gears immediately to the pre-market session. Those that are going to head off, have a great night. We'll see you on Skype. Remember, hit me direct on Skype. For those that want to hang out for the pre-market session, just hang aboard, and we'll get to it. Good night to everyone else.